For years, the conversation has been about whether self-funding is too risky. Maybe the better question is, what's the risk of doing nothing?
Turnover went down. The biggest relief was no longer dreading renewal season
She went from feeling powerless to feeling equipped.
without proper education or choosing a partner who doesn't understand all the nuances.
The future of employee benefits isn't about spending more. It's about making smarter decisions. Let's start with a reality every HR leader is living right now. Every renewal feels harder than the last. Healthcare costs keep climbing. Employees expect more from their benefits than ever before. And leadership is asking you to control costs without reducing value. And somehow you're expected to solve a problem that seems to get more expensive every single year. If you've ever looked at your renewal and thought, there has to be a better way than this conversation is for you.
Yeah, and you're not alone. More HR leaders at companies with 50 to 250 employees are realizing that the old fully insured model is no longer working for them. The monthly cost keeps going up with little explanation, and the tools you need to actually improve the experience for your people just feel out of reach. Today, we're going to talk in plain language about why more mid-market employers are moving to self-funded or hybrid models in 2026. We'll cover the real cash flow advantages, the visibility you gain, and how this shift can actually help you attract and keep great people while making your own job more manageable.
Welcome back to the Blueprints for Better Benefits. I'm your host, Rodney Mattos Jr., and as always, I'm joined by my dad, Rodney Sr. In every episode, we help business leaders navigate the complex world of employee benefits with practical strategies that replace confusion with confidence. Because better benefits don't happen by accident, and they're built with intention. And today's conversation is especially for the HR leaders who wear more hats than anyone else in the organization. You're advocating for employees, balancing budgets, supporting leadership, managing renewals, and somehow expected to make healthcare work for everyone. And if you've ever felt like you're being asked to solve an impossible equation, you're not alone. And this episode is for you.
Yeah, and today's episode is written especially for HR leaders at companies with 50 to 250 employees. You're the ones who live every day with the tension between what employees need and what the budget can actually handle. And Triforta serves as the Sherpa guide, helping you understand the options that are actually working for organizations your size. We're going to explore the accelerating trend of mid-market employers moving to self-funded or hybrid funding models. You'll hear about cash flow advantages, visibility gains, talent retention benefits, and real-world benchmarks on savings potential. We'll also look at what's happening right now through 2025 and midway where we are at today through 2026, and what it means for planning and heading into 2027. So if you're an HR leader who wants to bring better, more sustainable benefits to your team without overwhelming your plate, stick around with us.
So let's talk about one of the biggest misconceptions HR leaders hear, because I think this belief has kept a lot of organizations from even exploring their options. And the moment self-funding comes up, someone in the room usually says, we're too small. That's something Fortune 500 companies do. We don't have the staff, the resources, or the expertise to manage something like that. Is that still true today, or is the market changed?
Yeah, well, it most certainly has changed. And, the myth is that self-funding is only for very large companies and is too complicated or too risky for the mid-market employers, those for 50 to 250 person organizations. Many HR leaders believe they have to stay in a fully insured plan because anything else would create too much work or too much uncertainty or too much risk. But in simple terms, they think self-funding is not for us.
And I can understand why people think that. And for years, that's exactly what employers were told. So instead of asking, is there a better option? They simply renew the same fully insured plan year after year because it feels like the safest path. And most of the time, the problem is the safe choice isn't always the smartest choice. And sometimes it just means accepting another year of rising costs with very little control over that outcome.
Yeah, yeah, but here's what's broken, in that thinking. In a fully insured plan, you often have little or very little visibility or no visibility into what is driving your costs and almost no ability to make meaningful changes. You get one big monthly cost number. And when it goes up, you have almost no options. In a properly self-funded plan or a hybrid funding model sized specifically for mid-market groups, you gain real visibility into the actual medical bills. You get real data, get predictable monthly funding, and tools that you can actually put in place to help you support your employees far better than you ever could on a fully insured plan.
And that's the mindset shift. This isn't about becoming a giant company before you can think differently. It's about recognizing that today's self-funded and hybrid models were designed to make these strategies accessible to organizations that simply didn't have those options a decade ago. I hear this a lot. I mean, self-funding isn't just for the biggest companies anymore. It's for many mid-market employers, and it's becoming one of the most smartest strategic conversations they can have.
Yeah, absolutely. And that myth keeps becoming more expensive every year. Renewals keep going up by 20, 30+% is not unheard of, and it's not getting any cheaper.
Definitely not. So where do most HR leaders go wrong when they think or when they're thinking about funding options?
Well, I'd say the biggest mistake is assuming that staying in the fully insured plan is the safest and easiest choice. Now, many HR teams accept annual rate increases as just being inevitable, and they spend their time managing employee complaints. Obviously, has to be things that have to change and takeaways, and that creates definitely dissatisfaction, especially after renewal and open enrollment. So they're managing these complaints instead of addressing the root cause. So I'll give you a simple analogy. I think most HR leaders can understand and will resonate with them. So imagine you have a long-term vendor contract for a critical service, say payroll or HR software, or maybe a staffing partner in your organization. And what if every year they raise the price 12 to 15%, but they don't provide any explanation? They don't tell you anything, but you just get a bigger invoice. And you have very little visibility into the actual underlying costs. They didn't add any services. They didn't make it easier. They didn't do more work for you. But you can't adjust the pieces that matter most to your team. And that's how a fully insured health plan works for most mid-market companies. You get one big monthly cost, no breakdown. So imagine if you could finally see the real numbers behind that invoice. You could understand what's driving those increases. And you have the ability to choose the components that actually work for your people. And that's exactly what a properly structured self-funded or hybrid alternative funding model gives you. You gain the visibility and you gain the ability to make smarter choices instead of just accepting the next price increase. So you see, that same thing happens with health benefits. In a fully insured plan, you get one big monthly cost with just about no visibility. But in a self-funded or hybrid model sized perfectly for 50 to 250 employees, you start seeing the actual medical bills. You can make smarter choices because you get data and you actually get information where you can actually manage the details. And often we can reduce the overall spend while improving the employee experience and lowering the out-of-pocket costs for your employees.
And that really changes the role of HR instead of simply managing annual renewals. You become part of of shaping the company's long-term healthcare strategy. I mean, you're no longer asking, how do we absorb another increase? You're essentially asking, how do we build a better benefits program? That's much more a strategic conversation. So maybe the biggest mistake isn't choosing a fully insured plan. It's never exploring whether there's now a better option for an organization your size. So the mistake is not exploring the options that are now available for your size.
Yeah, that's absolutely right, and that's one of the main purposes of us driving this information and this messaging through our Blueprints for Better Benefits podcast series. Because, from our point of view, staying with the fully insured model because it feels familiar often means accepting more cost, less control, and more fire drills for your team year after year. And frankly, we're tired of the fully insured carriers playing the shell game. They have completely integrated their organizations. I think I looked at a recent report from United Healthcare. Well, they have over 3,000 integrations of vendors that they pay claims to, and those are all profit centers for themselves, and that's inflating the premiums for every employer that's subsidizing their profitability. So let's talk a little bit about what we're seeing, now in the middle of this year in 2026. And what we're seeing is a clear acceleration of mid-market employers with 50 to 250 employees moving to self-funded and hybrid alternative funding models. You see, people are finally really starting to pay attention. Many HR leaders, they're just tired of the double-digit rate increases and the lack of control. So for a typical 150 employee company, fully insured renewals, frequently seeing landing well above 10% into the 18% range and even higher. And at the same time, the average cost of employer-sponsored coverage has climbed to roughly $17,500 per employee. And that was just at the end of 2025. And it's projected to rise another 6 to 7% through the end of 2026. And we know it's not going to go any lower in 2027. And then you got pharmacy costs have been even hotter. They've been driven in large part, of course, we all know the GLP-1 medications and other specialty drugs. So in a fully insured plan, those increases often arrive again with little or no transparency whatsoever. And you just get a bigger number and limited ability to see what's actually driving it or to make any type of targeted changes and improvement. So by contrast, you think about what, all the solutions that we can apply and all the levers we can pull in a well-structured self-funded or hybrid alternative funded plan, especially level funded plans designed for the mid-market, and they're delivering more predictable monthly funding and real visibility into where all the money's going.
Yeah.
So, yeah, it's just crazy. So what we're seeing right now is a clear acceleration of that mid-market employers, moving away from traditional fully insured plans. They're just tired of it. And many HR leaders are tired of those double-digit rate increases and all that limited control. So let's talk real quick about looking ahead and what we're seeing trends going into the end of 2026 and into 2027. There's three things that really stand out. First, there's AI tools that help identify cost drivers early, and personalized support are improving quickly. Second, the competition for talent in construction, manufacturing, and mining, and other industries is only getting tighter, and benefits that feel thoughtful and stable are becoming a real retention advantage. And third, which is key, is employers who continue treating the fully insured renewal as inevitable, they will fall further behind competitors who now have data and options that they just don't have. So for HR leaders, the urgency is real. If you wait another year hoping the next fully insured renewal will be better, you may find yourself explaining even larger increases to employees while your competitors are already using visibility to stabilize costs and improve the employee experience, and especially when they lower the cost for care for your employees without cutting benefits. And that is a advantage you can't afford to let your competition get over you.
Yeah. So more companies of that size are making the move, and the window is open right now, it sounds like.
Yeah, most definitely. I mean, the trend is really shifting, and people are, what I would say, kind of becoming enlightened and waking up to what we have seen for a couple of years now as an inevitable, direction and migration away from the status quo, the fully insured carriers, and renting the plans and being under the thumb of those fully insured shareholders that are really focused on driving profits for their organizations and transitioning to actually owning your own health plan and being able to control it. So, and many employers are doing it successfully without overwhelming their HR teams.
Let's touch base on talent and retention. How does this trend connect that?
Yeah, well, it definitely connects directly. As I mentioned, in many markets and many industries, there's a very tight labor market, especially in construction, manufacturing, and mining, but it also impacts a lot of other industries. Employees are paying very close attention to the benefits as part of their entire, employee value proposition, their total rewards package as they're known today. So when HR can show that the company is actively managing costs while keeping or improving coverage, it really builds trust. And a self-funded or hybrid funded model often gives HR the ability to offer more predictable benefits, much faster claim support and concierge services to their employees, and even lower employee contributions with better wellness options. And all of that translates into higher satisfaction and better retention for employees and their family members. Many HR leaders tell us that once they gain visibility, they can finally have honest conversations with employees about benefits instead of just apologizing for rate increases and having to take coverage away or increase their deductibles or their out-of-pocket maximums. No one likes to have those conversations, and they don't have to have them anymore. The HR team stops being the messenger of bad news, and they get to start being the person who can explain why the plan is getting better over time. That's a much different conversation. And I know there's more HR teams out there that would prefer that over the alternative. So in competitive industries, the companies that can say, we have more control and we're using that control to take care of you, they win more of the talent battles that matter.
This segment is brought to you by the people and platforms that make this show possible. First, Triforta. If you're an employer who's tired of runaway renewals, bloated, fully insured plans, and the feeling that your benefit strategy is working against you instead of for you, then hear us clearly. You do not have to play that game anymore. Help business owners fix broken health insurance. We bring cost containment strategies, self-funded captives, data intelligence, and real-world case studies that routinely save employers 6 and 7 figures without cutting benefits. If you want a benefits plan that actually rewards results, visit Triforta.com and download our blueprints for better benefits. And second, Aperionics. If you run an insurance agency and you're still drowning in manual quoting, data entry, or commission reconciliation, you're leaving more than time on the table. You're leaving money. Aperionics is the automation layer built by insurance people for insurance people. AI quoting for carriers that don't have APIs. Instant policy data extraction, commission statement automation, proposal generation in seconds, not hours. Aperionics reduces operating costs and gives teams their time back so they can work at the top of their license. Learn more at aperionics.com. That's APEIRONIX.com. Triforta and Aperionics, 2 companies, 1 united mission. Fix what's broken, elevate what's possible, and help real people thrive. Now let's get back to the show.
So here's a truth that we believe many HR leaders really haven't heard yet. Self-funding or a hybrid alternative funding model isn't about taking on more risk at all. It's about gaining more control and visibility so you can actually improve the benefits experience for your entire team.
I think that's the mindset shift. For years, the conversation has been about whether self-funding is too risky. Maybe the better question is, what's the risk of doing nothing? It's probably because healthcare costs continue to rise, renewals become less predictable, and you still have very little insight into where your dollars are going. Staying with the same status quo has consequences too. So sometimes the biggest risk isn't exploring a new strategy at all. It's assuming the current one will somehow produce a different outcome.
Yeah, you know what they say, the definition of crazy is doing the same thing over and over again, different result, right? So,
yep.
But for many mid-market employers, the greatest risk isn't change. It's staying in a model that becomes more expensive every year while giving you less transparency and less control. You see, when the structure is set up correctly with strong protection against big claims and clear monthly funding, most HR leaders, they find that their day-to-day work really becomes more manageable, and fewer surprise renewal battles, they get better answers for their employees and more credibility with their leadership team. And that's the real reframe that we're focused on.
Right. And so could you please share some real examples of HR leaders who made this move successfully?
Yeah, I mean, there's so many to think about. Like we've said, we've probably in the last 4 years, there's been over 1,000 employers that we've been able to help at Triforta make this transition, and some of them, took a little longer to understand the process. I think we've gotten much more sophisticated at providing the education, the support, the reassurances, and also just really the processes of navigating this really efficiently. But there's one employer that stands out. I think there were about 165 employees in the manufacturing industry. And I remember the HR director was, as many of them are, was pretty exhausted. Every year she had to explain. I think the last increase was on their fully insured plan was about 15% renewal, and that was coming off, several years of double-digit increases, and having to explain that to employees again. Obviously, she felt caught in the middle. Obviously, wanting to support the team, but having no control over the rising costs at that time, and every open enrollment felt like damage control.
Right.
And she was just spending more and more time fielding complaints instead of doing any strategic work. And when they moved and started working with us at Triforta to a self-funded model we put in very strong stop-loss protection. The first big change was visibility, getting access to data. And for the first time, the HR team could see actual medical bills each month and understand what was driving the costs. They could see who their high-cost claimants were and what type of chronic conditions they had. And that was the turning point. Instead of just accepting the next big increase, she and the leadership team used that data with our support to make targeted design adjustments and improve how they communicated the plan. And in the first year, they reduced their overall spend by about 9% while maintaining coverage. They didn't have to cut any benefits at all. In fact, they actually improved the benefits.
Mm-hmm.
Do you think what happened to employee satisfaction? It went up.
That would have.
Yeah. Turnover went down. And the HR director later told us the biggest relief was no longer dreading renewal season. They finally had real information to work with and could have really, productive conversations with employees instead of just delivering another round of terribly bad news after renewal time.
And she went from feeling powerless to feeling equipped, I'm sure.
Yeah, no doubt. There's one other one that stands out to me. I think about this other example. He's about 120 plus employees in a construction firm, and the HR manager was spending obviously a lot of hours every month fielding questions about why deductibles kept rising, which is a common theme, when you go through renewal process with a fully insured carrier, and why they had to, have less generous benefits than what they had before. And cash flow is already tight, especially, in a construction firm, because they have some seasonal nature of the work, which is not unusual. Sure. And a big fully insured renewal made budgeting and bidding a lot harder. So after switching to our hybrid funding model sized for their group, they gained better cash flow predictability and monthly visibility into claims. So they got to use some of that savings and the new data to add a wellness program that employees actually used. And the HR manager told us it reduced her administrative burden because now she could answer questions with real information instead of guessing. And employees' questions actually dropped. And morale that around benefits, that improved significantly. And their leadership team, they just were more confidence all around in their ability to plan. So one other one stands out to me is about a 95 employee company that was doing some welding for a mining company on their site, building out different towers and tanks. Their HR leader was worried about talent retention in obviously it's a competitive rural market
Yep.
as genuinely are located. You've been out to these sites. Experienced people, had options and benefits were becoming a deciding factor. They're competing with other companies that have already made the switch to self-funding. So the self-funded approach gave them visibility and control that let them stabilize the benefits and improve communications around the plan. And the HR leader said the biggest change was that she could finally be transparent and proactive instead of reactive. And she was able to stop spending her days defending decisions she didn't make and started shaping a plan that was a better fit. It fit better to the real needs of their unique workforce. And what happened with retention? It improved, and recruitment conversions got a heck of a lot easier. So that reduced her workload, and everything became more sustainable. So in each of these cases, they're similar but different because every employer is unique, and you have unique needs and plan designs and structure. But overall, the theme is the HR team gained confidence, and they got better tools, and they got the ability to focus on supporting people rather than just managing the complaints about the rising costs.
Yeah, that's important. Another question I wanted to ask you is, for an HR leader listening right now, walk us through what this actually looks like from a practical standpoint.
Yeah. Well, think of it like finally getting a detailed monthly budget report instead of, one big annual bill. You see, as we all know, in a fully insured plan, you get one lump monthly cost with almost really no breakdown other than, cost per employee or employee plus spouse or whatever. But you don't see how much is going to hospital care. You don't see how much is going to physician's visits or to prescriptions or any of the other categories like imaging and labs and so forth. And you don't see any trends early because you're not getting any monthly information. You just get the big number at renewal. But in a self-funded or hybrid alternative funding model, and again, we're focused on employers between 50 and 250, but this works for employers that are fully insured, even in the 1,500 employee range. You start seeing, and what you get in differences, you get the actual medical bills in this report each month. You can track trends and you can spot, high cost areas early. If you start seeing chronic conditions that are hitting and causing high cost claimants, we can start to put in point solutions that address those and bring those costs down significantly. And you add that up, all that adds up over time, especially when you're making small adjustments. You can bring those costs down.
Sure.
And so for typical, say, 150 employee group, those employers are seeing monthly funding that is more predictable than the old renewal roller coaster. Some are saving, on average, 8%, but as much as 12 to 15% in the first, 18 to 24 months, while maintaining or even improving. Most of the time, it's improving the actual coverage for their employees. And the savings often comes from really better visibility, data, and being able to manage the plan rather than cutting benefits. So imagine a simple example. In the old fully insured world, you get a 14% increase, and you have to decide how much of that to pass on to your employees or absorb. We call
Absolutely.
what do we call that? A benedictomy, where you take
Yeah.
something away, right? But in the new model, you can see that a large portion of the increase was driven by a few high-cost areas, and now you can pinpoint, and you can actually focus on those areas. You can then make targeted changes, and better access to preventive care could be helpful. Smarter pharmacy management could be the lever that you pull, or wellness support. So you have all these levers that you could pull that even if you tried to pull them in a fully insured plan, the fully insured plan wouldn't even let you. So all of that allows you to improve outcomes and reduce future pressure. And that visibility turns a pure cost problem into something you can actually manage, finally. And
Yeah.
that's what our mission is about here at Triforta, helping employers get to a point where they can actually start to own their plan and manage it instead of being completely at the mercy of the fully insured carriers.
Yeah. So instead of opening your renewal packet once a year like it's a horror movie and wondering how bad is it going to be this year or this time, HR leaders actually get to see what's happening throughout the year. No more flying blind, no more hoping next year's increase isn't another surprise. And you finally have enough information to answer leadership's favorite question. And that is, why are our healthcare costs going up? And even better, you can walk into that meeting with answers instead of just guessing. So I think exactly right. Having more information at your fingertips is definitely helpful.
Yeah, no, I mean, like we always say, you can't manage what you can't measure, and you certainly don't get any information that you could measure on a fully insured plan. So there's no ability to manage anything. So that's exactly right. And the bottom line is that visibility is one of the biggest reliefs for your HR teams.
Now let's talk about what happens the minute an HR leader brings this idea into a leadership meeting, because it usually doesn't take long for someone who's can say or ask, this sounds interesting, but what's the catch, or what's going to manage? Who's going to manage all of this? Are we creating more work for you guys in HR? I mean, what are our employees going to think? Or more importantly, what happens if we have one really bad claims year? And those are all fair questions. So, how do you help leadership teams separate the myths from reality?
Yeah, no, all great points and all questions that we've heard and addressed effectively and confidently. But I'll tell you the most common question is, won't this create more work for a small HR team? I think that's one of the ones you just mentioned.
Mhm.
So in reality, many HR leaders find that better visibility actually reduces the number of surprise questions and the fire drills that they have typically gone through at renewal time. Instead of spending weeks scrambling for answers, they have data and clear explanations ready at their fingertips. Another frequent question is, hey, our employees won't understand the change. Well, the best approach is simple and transparent communication. And we handle that at Triforta very effectively. So we're taking more control. This is the talking point that employers use and that we coach them on. But the key is to let employees know we're taking more control so we can keep benefits stable and sustainable for the long term. Especially when the costs go down, employees are going to feel much more appreciative. And
Mhm.
most employees respond very positively when they see the company is being thoughtful and when they get clearer answers than they ever had before, especially if their benefits aren't going away, like higher deductibles or higher out-of-pocket maximums. And then you have some HR leaders that worry, hey, what if we have a big claim year? This one typically comes from finance, and they feel that a bad year could blow out their budget. But we talk about this in other episodes pretty extensively. And of course, properly structured self-funded plans or hybrid alternative funding models, they all include very strong stop-loss protection. And when appropriate, captive layers that smooth out and limit exposure even more. So really what happens is the risk is managed and the visibility helps you see issues early so you can respond and manage them more effectively. A fourth concern we hear is leadership won't support the change. The most effective response is to bring a clear side-by-side comparison that shows not only potential cost impact, but also the reduction in HR fire drills, the improvement in employee communication, and the long-term predictability. So when leadership sees that you got a 5-year, 10-year outlook, and we have historical data points that show how much lower the costs are in our properly structured self-funded model versus your typical 9+% renewal increases on a fully insured plan. When leadership sees this, it helps the business and makes HR's job much more strategic, and support usually follows.
I think that's reassuring because none of those questions are deal breakers. They're the questions every good leadership team should be asking. And when you have thoughtful answers backed by data and solid strategy, the conversation ultimately changes. Instead of asking, why would we ever do this? The question then becomes, should we at least take a serious look? And honestly, that's usually where the best decisions begin.
Yeah, no, it's very true. The key is focusing on how this change helps HR do their job better and supports employees more effectively. You see, the biggest pitfalls are jumping in without proper education or choosing a partner who doesn't understand all the nuances mid-market employers need. Another common pitfall is focusing only on the cost number and forgetting about communication and employee experience. So we have some practical next steps that we recommend for HR leaders. And the first is, ask for a side-by-side comparison of your current fully insured plan versus a self-funded or hybrid alternative funding option sized specifically for your group and your group's demographics, including estimated impact on monthly funding, predictability, and your own administrative time. Then, two, request clear, plain language explanations of monthly funding, visibility, and protection against big claims. How is all of that going to be structured to protect your organization if you had a bad claims year? And third, schedule a discovery call focused specifically on HR workload and employee communications. Talk with one or two other HR leaders who have already made the move so you can hear the real day-to-day experience. If you want to attend member meetings where you can sit down with other employers who have already made this change, we invite you to attend one of our annual conferences. We have these several times throughout the year, typically the first quarter of each year, and usually in June, and then usually in August or September. You can visit triforta.com and mention mid-market self-funding, and we'll walk you through the options in simple terms and help you see what the path should look like for your team.
If there's one thing we'd like you to take away from today's conversation, it's this. The future of employee benefits isn't about spending more. It's about making smarter decisions. And for HR leaders, that means having the visibility to understand what's driving costs, the confidence to bring new ideas to leadership, and the flexibility to build a benefit strategy that's sustainable for years, not just the next renewal.
Yeah, no doubt. More HR leaders in the 50 to even 1,500 employee range are discovering they can reduce cost pressure, they can improve cash flow predictability, and they can strengthen talent retention when they have the right structure in place. They also discover that their own jobs become much more manageable and they get to be more strategic.
And that's what Blueprints for Better Benefits is really all about. Helping employers move from simply managing healthcare costs to leading a smarter benefit strategy. Because as we always say on this show, self-funding isn't the finish line. It's the foundation for building something better for your organization. And if today's episode challenged the way you think about employee benefits, share it with your CFO, CEO, or leadership team and start that conversation. And then visit us at triforta.com to explore whether a self-funded or a hybrid health plan could be the right fit for your organization. Until next time, keep asking better questions, keep building smarter strategies, and thank you for climbing with us. I'm your host, Rodney Mattos Jr., and we'll see you on the next episode of Blueprints for Better Benefits.